Ladies and gentlemen, welcome to another Independent View with Lobo Tigre. Our guest of the day is Ross Gerber. He's the CEO of Gerber Kawasaki, a wealth and investment management company. I have to tell you, I had no idea who Ross was a couple of weeks ago. We were both at the New Orleans Investment Conference, and I missed his presentation. I was otherwise engaged. And I ended up sitting next to him at lunch, and he started saying really interesting things about negative interest rates, what's going on in the broader world. And what really struck me is that Ross is not a gold bug. He's more of a mainstream investment analyst and investor himself. And I thought it would be useful to get the perspective of somebody who's outside our bubble, dear audience. So Ross, welcome to the show. Why don't you give us a quick overview of what you do, what your company does, and then let's talk about investments.
All right, thanks for having me, Logo. I really appreciate it. So I'm Ross Gerber. I'm president and CEO of Gerber Kawasaki Wealth Management, and basically I've been an investor since I was a little kid, and I got stock for a birthday present when I was 13, and fortunately with stocks like Apple and Disney and IBM. And as a kid, I'm actually a musician, and I really thought the stock market was going to be the key for me to be able to make money and be able to pursue my passion, which was really music. And so I wanted to learn how it worked, and I grew up in the 80s, so it was kind of a great time to get experience in the stock market. Obviously, I did pretty well with that Disney through the 80s, and I was kind of sold on this as it was sort of a hobby at the time. But I was also fascinated by money because I wanted to be independent from my parents, and not that it was bad, but I just wanted to be independent. So I was like, how does money work? I need to learn this. And so when I was 16, I was really, really determined to learn how money worked. And then I went to school at the University of Pennsylvania. I spent a certain amount of that time studying at Wharton, and I learned a lot about business. But I also this was the beginning of the 90s, and I was very involved with technology. Actually, I'm mostly a technology, entertainment, and communications investor. That's kind of our specialty, or my specialty.
Okay.
So I started my career as an investor in the early 90s because I went to the record labels and started working at Atlantic Records, and I saw pretty quickly how technology was shaping the industry. But in their case, they were not adapting to the technology, and I basically was like, boy, this industry is going to struggle and suffer, and I should look at something else. And the only other thing I could do that actually made money was stocks. So I found a company that was called SunAmerica at the time, and we sold mutual funds and annuities and retirement planning. And I was lucky enough to start my career in 1994. It was the beginning of the greatest bull market that I've seen in my life. And so that was great. So the first .com rally from 94 to 2000 made me pretty wealthy for a kid relative to being a kid. And then I proceeded to lose a big chunk of that. But I was able to build a career around advising people of all ages and backgrounds. That's kind of the secret to my firm. We don't have minimums at my firm. And, I really found that advising only the ultra wealthy was one of the most unsatisfying things that you could do in money management. It really is. I have an ultra wealthy client right now, texting me about, I want to buy options in Walmart today and this and that and the next. And I was like, geez, buddy, options in Walmart, So I found helping what we call the mass affluent, people sort of in the middle, was really satisfying. You can make a huge difference in their lives, and people were in desperate need of good financial information. So when the financial crisis rolled around, our firm, SunAmerica, was bought by AIG. So I was sitting sort of in the front seat of the disaster.
Wow.
And yeah, it sucked. And, I could do a whole podcast on the financial crisis.
That's a technical description. It sucked.
Yeah, that's a nice description, really. And at the same time, not only was I losing my own money, the clients were losing money. There was the risk of just the insurance, even the guaranteed products could have gone under that AIG had. And boy, it was a really bad time. So when we kind of got through that, my partner currently at the time was actually working for me at my other firm. And we decided to leave because we had one major partner who didn't want to change a thing, and we were still bricks and mortar, and we had offices all over. And I said, we got to shut all this stuff or start over. And so I decided to start over with my partner, Danilo Kawasaki. This was 2010, and we hoped if the economy got better, this would be a perfect time But the idea was to start an RIA to focus on not just the wealthy, but the mass affluent, focus on younger people, and leverage technology, social media, and the internet to build our business. And so we were really the first innovators to use tools like, we're actually the first firm to ever use Facebook, one of the first firms to use Instagram, just recently actually.
Sorry, let me just to clarify, first business to ever advertise on Facebook of all, not just financial, but
all financial firms, yeah, all financial.
All financial,
yeah.
Okay.
Yeah, so we were actually using Facebook when it was still like the college, you had to have a college email. I was like starting to test it. And yeah, I had to take, my stepfather was actually the chancellor of UCLA at the time. So I was trying to take his email. He's like, you can't open a Facebook account with my email because, they'll be like, the chancellor of UCLA is on Facebook, And, but we started posting, and part of the reason we got away with it was that AIG was in such disarray. The compliance people didn't exist. So we were like, let's just post, see what happens. And we got thousands of fans right off the bat. It was really cool. I think we still have like 30,000 fans, and we don't even really use Facebook that much anymore, ironically. But we've always pushed the boundaries, and also on Twitter, which is also where we've become pretty big, and now in traditional media as well. So we've leveraged that to build. Now we're about to cross $1 billion in assets. We have actually about 6,500 clients, about 15,000 accounts. We have one office. We have 20 investment advisors who work here, and a total of 30 employees. And we're here to help people all across the country. We work by video, we work by audio, we work in person, but we're leveraging the technology so that we're able to help lots and lots of people. And then we're also not a robo-advisor. We're managing portfolios for people, individualized. We're giving financial advice, financial planning to each client, no matter where they are in the wealth cycle. From the beginning, I've never invested, to I'm very wealthy. We have a program for you. And so our ultimate goal is to help as many people as possible reach their financial goals.
Well, that's a succinct summary. Thanks. I looked over your website and I looked at the products, and I'm looking at all this, and that question actually came to mind. How do you do this for 6,500 people? I mean, clearly there has to be some automation here. You can't sit down and have a chat with 6,500 people, or you'd have to have 6,500 advisors to do a one-on-one. What's the balance there?
Well, traditionally in our industry, each advisor typically would have 100 clients. So if you go to UBS advisor, who manages, minimum $1 million accounts, they usually have about 80 to 100 clients with an average account of over $1 million. So you have about $100 million book as your typical UBS or Merrill Lynch broker, but they can't grow. Once they get there, it's really hard to grow and scale because each client has to have its own thing. What we found was that a vast majority of people with less than $500,000, we could build portfolios for them that we actively manage, but we wanted to do that centralized because there isn't that much difference in their goals. Mostly it's growth or growth in income when you have less than $500,000. So with the technology advances that have recently happened the last 3 or 4 years, we are able to now centrally manage portfolios of similar objectives like they're an individual account, but for thousands of people. So we can buy and sell stocks. So it's basically like a super complex robo-advisor. So instead of, like, the robo-advisors are very simple programs where you have 5 or 6 ETFs and it just like builds a simple asset allocation. We're breaking that down now to 20 or 30 positions, stocks, ETFs, and mutual funds to build the portfolio so that we can add diversification, ultimately make our portfolio safer and have higher alpha or higher returns based off their objectives. And that's what we've been able to do by adding individual stocks. I'm a big believer if you don't own individual stocks, you will never have any amount of real wealth.
I got to jump in, and I got to agree with you there. I'm not a huge fan of passive investing, and I think this whole ETF thing, it's going to end badly when people rely on just ETFs.
It's going to end with a lot of people not reaching their financial goals, because what the robo-advisors don't want to tell you is the simple math that if I build an ETF model, I'm going to probably average 6 to 8% over the long term. And it's mostly because of over diversification and too conservative of an approach, and especially with younger client base and even older client base, because our life expectancy is so long now that not investing for growth in individual issue stocks really will prevent you from actually reaching your financial goals. So you can just punch it into your calculator. If I earn 6 or 8% and I save this amount of money, I have absolutely no chance of retiring. So I just don't get that, because the secret to retiring is you have to have some of these kind of companies that become these iconic leaders of the future. And that's how I've built a large amount of wealth myself. And that's mostly through technology. And that's where we're mostly concentrated in when it comes to where can we earn extra return. So if you actually compare a chart of the NASDAQ to the S&P, the NASDAQ has always beaten it. And so you're much better off in the NASDAQ than the S&P 500. That's a simple way to beat the market, without even trying. Why? It's more focused on technology. So by adding that technology and our expertise in, we're able to get higher rates of return without necessarily increasing the risk level. So that's the real challenge of what we do. How do we get higher rates of return and not really increase risk? Anybody can get higher rates of return and increase risk, and so that's the challenge of finding good companies that have, reasonable prices, that have catalysts to help them grow to become even bigger companies. Like right now, we're just having a great time with Disney and making great returns in Disney, and it's been actually a great couple months for us, because the truth is, when stocks hit, you make a lot of money. It's a lot of fun.
Understood. Before we move on from this, just real quick, it's only SemiAuto. If you have an epiphany one morning, you think, I think the markets are really going to change, or we're at a major juncture or something, then you will go into your systems and you'll make adjustments to the portfolio. You'll tell it somehow, we need to be risk off here, or we need to do this, and that will proliferate through the portfolios?
Yeah, so like we can just take, let's say, we have them in blocks. Let's say we have a block of accounts that are growth and income for people with less than 500,000 but over 250,000. So we'll take that portfolio and we can just knock 10% out of the stock market and move it into the bond market, let's say through an ETF trade or a mutual fund trade, just shift those allocations, and it'll do that trade for all 6,000 accounts. So it's you have to be very careful. We have very strict procedures, because if you mess up, it's like, it's nuclear, but it allows us to manage like 5,000 accounts like it's one. It's really insane. So you just have a lot of procedures before and after to make sure it all works correctly. But, I want to move out of the stock market. I move 10% out, I push a button, and I move it out for thousands of people. And that's through the wonders of modern technology. And we weren't able to do this just even 3 or 4 years ago.
Wow. Okay. Well, one last question then on the company, and that is, I didn't see somewhere on the first pages I looked at a track record, and I realize past results don't guarantee but what do you tell people to say, what's your track record?
See, what I say is that you shouldn't invest with us based off just hoping to get high rates of return. When you put track records on websites, the SEC they scrutinize you incredibly highly, and every portfolio is a little different for our clients. I have clients that call me up and say, this is just too scary for me right now. Can I have less exposure? And I'm like, listen, it's not my job to scare the hell out of you every week. I get it, and we'll cut exposure for them. So when clients ask us, like, what are our returns over time? What I do is I say, well, it depends on your objective. And then if they have an objective, let's say growth and income, we have many accounts that are real accounts that fit that objective. So what we'll do is we'll print out those accounts, what those positions are. We've been with one custodian now for over 7 years, so we have, like, let's say an easy 7-year track record that we can punch up. We've tracked it internally since we started the firm 10 years ago, but those internal numbers aren't audited. You know what I'm saying?
Yeah.
So it's like, so we'll show an actual account, we'll redact all the personal information,
sure,
and we'll say this is an account with a similar allocation that we've managed for the last 7 years. Here's the returns, here's the benchmarks, here's why and how things have worked or not worked, and so what I say is we're very good at what we do. Sometimes we're on fire. Like right now, we're just killing it this year. We're well ahead of the market now that Tesla's come back. It's been a great year. But last year we underperformed. It was like we kind of got whacked with our gaming positions at the end of the year. And, we lost a little bit more than the market last year. I wasn't happy about it, but we've made it back up this year. So over time, over the 7 years, we've produced alpha over our benchmarks, and clients just have to stick with us, and they'll see the positive.
Excellent. Okay. So now we understand your perspective. We understand what you do, and you're not a gold bug. Clearly, you're
Well,
buying.
I like gold.
Okay.
I'm not a gold bug, and I do own gold. I was actually playing with it last night in my house because I was. Well, I own these gold coins. I love gold, and it's mostly because it's a connection to history. When you talk about monetary policy and you look at how much money we print today and the embarrassment that we call our central banking system, gold is still a storehouse of value after 5,000 years. So there's something to that. I bought most of my gold years ago. It was probably over a decade ago when it was about $500 an ounce. And this was leading up to the last.
So do you have a swimming pool there full of it? And do you do a Scrooge McDuck?
No, I got these coins and I'll lay them out on my bed and be like, look, kids, gold coins. And then they want to play with them and I have to take them away. But no, I think that gold has a place in a portfolio today that it didn't have maybe over the Obama years, where we had sort of low growth, low inflation, and really a more disciplined, financial government approach, I guess you could say. Today, with going back to where we started with negative interest rates and money printing and central banks and governments that are the worst in history, maybe, I think gold has a place in a portfolio and should be in. And we've been buyers of gold recently as instead of just holding cash. So I think it's a wonderful hedge in a market like this.
Okay, all right. Well, fair enough. But so how do you square these things? I mean, if I'm thinking in my head, I'm trying to see how I put these pieces together. I like technology stocks. I like Tesla. I like things that depend on the economy continuing to boom. But at the same time, I'm aware of just these insane central banking policies and craziness and trade wars and all these fountains of chaos we have in the financial world today. How do these square in your head? How do you sleep at night with mainstream investments when you're smart enough to know that negative interest rates tell us something really important and it's not good?
Well, so one thing that I do believe is that the system is rigged to go up, and that's clearly been proven over 200 years. So, other than when they totally screw up, like 10 years ago, printing money is actually good for assets, to some degree. Like if I own gold or land or a company that produces a good that is profitable, I have to put that in now because so many companies don't make goods that are profitable. But if that asset becomes more valuable because of inflation, they can raise prices, they produce a cash flow, hard assets become more valuable. Like I would rather own, let's say, land in Europe than a currency in Europe, right? So
yep.
It's like, so I think the system is really screwed up right now, but I also have to make money. And so the system creates potential for bubbles, especially in bonds, which I think is where the bubble is, But the stock market's been reasonably priced, through all this. I think the stock market should be, have a PE 4 or 5% higher based off the monetary policies we're seeing. But investors have so little confidence in governments that PE ratios really aren't that elevated.
Actually, let's stop and let's dial in on that for a second, because that was going to be my next question. I look at equities in general and the valuations on a more historic perspective, and it seems to me that the valuations are insane now, and you're saying they should be even higher. But what you're actually saying is based on monetary inflation.
Well, you got to divide the market into different categories. You have stocks that are ridiculously priced, like Roku and all that kind of garbage stuff that is just speculation. When a stock trades at 10 times sales, that company better just kill it every month, and it's still fully valued. You know what I mean?
Yep.
So those companies are, we don't touch. It's just there's no, Roku makes no sense to me, and some really smart people I know love Roku, and I'm like, it's a box anybody can make, but the valuations are crazy. And then you've got companies like Disney, for example, where historically it's a little bit overvalued, but if you look at what they're doing as a business right now, boy, they're in great shape. What a great business. And overvalued is, it's at 24 or 25 times earnings. If you look at, so I look at 20 times earnings is kind of like where the point is. If you got a PE less than 20, like Verizon, it's got a 12 PE and a 4% dividend, I'm buying it. I'm a buyer. I can't even get that in a bond anymore, So it's like there are pockets of value. We wait for pullbacks in good companies to buy them. We don't, stretch out and buy Google at the top. Actually, that's what earnings has been great for. When you have a good company just get hammered after earnings, that's when we look to buy them. So you can buy them at whatever price you choose, right? So I don't think the market's cheap, especially today. The market's moved up 5% or so pretty quickly. But if you go back just a few months, the market was much more reasonably valued. So I think it's tougher today than it was just a few months ago with the market at all-time highs. But still, when you go back to the 90s, when I started as an investor, as a professional investor, the S&P at the peak had a PE of 32. And right now I'm looking at a forward PE of maybe 16 and a half or 17. It's not a bubble.
Fair enough. On a related topic, these unicorns.
Yeah.
and since you're a technology investor, I mean, what do you make of that? And, it seems like with the disappointments we've had this year, maybe it's the death of the unicorn, or is that much ballyhooed? Are people still going to get so excited about stories that you'll be able to IPO at multi-billion valuations without ever having made a penny of profit?
Well, once again, I started in the 90s. This is the same cycle. The only difference with this cycle was that the private investors are the ones eating crow, not the public investors. And I'm super happy about that, because that's what really brought down the markets in .com, was the fact that these companies that were garbage went public earlier. Investors bought into these stories, made money off the bat, and then got devastated. Where the private equity guys were so greedy on this cycle, they held it all the way to the top. And then they're trying to use the IPO market to unload their stock, basically. And people like me, we go out on TV and we're on Twitter every day saying, watch out for Peloton. Smile Direct Club. I mean, somebody bought this, Snapchat, Uber, Lyft. I mean, the list is just so long of companies that are going public at the end of their growth cycle, not at the beginning or the middle. And so investors have now caught on to this, and they're punishing valuations. And WeWork was the turning point. So WeWork was so big and visible and bad in every way that across the board, we're even seeing it in cannabis. And cannabis is a great business, and it's getting hammered. And I'm really happy about it, actually, because we want to get more into cannabis. And prices have come down. But these are businesses I've gone into that are literally printing money. So I think, as a business owner, a lot of investors don't understand how businesses work, like a real business, and so they buy into stories. But I think that that era is now past us, and investors have been burned over and over again by these companies. And fortunately, it's the private equity guys. It's SoftBank that's eating crow, not my clients, not the public, and that's going to be really good for us longer term.
All right. Well, I had also intended to ask you about geopolitical risk, but now that you've corrected me on the gold thing, I think I have an answer to that. But it strikes me, and maybe you could just comment on this, it just strikes me, it seems like the folks on Wall Street don't seem to understand or appreciate how serious a number of things are around the world. And we look at this thing in Bolivia, for example, or Chile, and it seems to be, that's some far off land, who cares about those brown people over there? They didn't say that, but it just seems like Wall Street just writes these things off. And maybe if it was one country, I could see saying, okay, well, that is far off. But it's not one country. There's a whole continent, and it's not just that continent. It's Africa. There's Hong Kong. I mean, there's a lot going on. There's a lot of geopolitical, and this is just one aspect of it. And it seems to me that you look at the Dow and the S&P hitting record highs in such a volatile world. How does that make sense?
Well, I'll just point you back to the Civil War, or the Cuban Missile Crisis, or World War II. It's just the anniversary of Kristallnacht, and you think about today. Come on, these problems are nothing compared to what the world's been through in the 20th century. So how many U.S. soldiers died in combat today? And we went through a decade of Vietnam, and then Nixon and then the gold standard, and then, so the biggest problem we have today is greed. I mean, I think that's clearly the message Elizabeth Warren's sending, and it's the message Trump is sending, is greed is good, and Warren's saying greed is bad, and we got to take the money back from these people. So Wall Street only cares about money. They literally, like the president of Uber literally said, cutting up some journalist's body was a mistake, and we all make mistakes. I mean, the guy said that on television, okay? Like, oh, we ran over somebody by accident, and it's similar. And then he was like, oh, I take it back. This is really the mentality of Wall Street and the sort of Silicon Valley elite, where they're so out of touch with what is important longer term now, because it's just a money grab for today. So they're all going to be so rich, and the world's going to plunge into climate crisis, and all this money, that's kind of what we were talking about earlier, doesn't mean anything if your Malibu house gets swept away or burned up or whatever. You should have seen all the rich people fleeing the fires in my neighborhood just the other day. I mean, it's like hysterical in a way. They're so busy investing in oil companies and figuring out ways to make money and banking and this and that, and then they're fleeing climate change that they're helping promote, half of these people.
So I got to jump in and tell the audience that you live in California near some
I
of
live in
these
California,
wildfires.
and I grew up hating Wall Street, and I still hate Wall Street, and that's why we're on Ocean Park and not in New York. And I mostly hate them because too much greed always ends poorly. And I watched it, and I suffered through it greatly in the financial crisis. And I learned my lesson about these people in the financial crisis because, boy, Mazzillo, the guy from Countrywide, never spent a day in jail. He's living the high life here in LA still. He's super low key. But boy, nothing happened to this guy after selling billions and billions of toxic mortgages to people. So our society has issues, and I think the wealth inequality issues are legitimate. I think that things need to change. I don't like the solutions that are being put out there, because just taking money from one to hopefully make things fairer doesn't work. We have like a systematic failure in certain moral, obligations that CEOs should have, that Wall Street should have. Just like basic integrity is gone. Maybe that's partially because of social media. I don't know.
Well, that would be a very long conversation, but I'll just leave you with that. The one question I usually end an interview with when I'm grilling mining company CEOs is the skin in the game question. Your business is a little bit different, so let me ask you, do you invest your own money in the kind of investments that you recommend to your clients?
Yeah, in fact, it's almost like opposite, where I started doing this to invest my own money. I actually originally had no intent of investing other people's money. I kind of wanted to be like Gordon Gekko. I was like the big fish calling down to the floor of the exchange. That was kind of, I was like, I want to be a big trader one day, which I am now, except you don't call anybody anymore. And so, when I was, trying to make a living at 24 as a musician, and I was trading stocks, people were asking me for help. And so I was like, okay, this is what I'm buying and selling, and I would write it down. And then one of my friends who was a lawyer, an older fellow, was like, you can't just do this. You have to get licensed. Yeah. So I kind of fell into the business. And so when I started, that's all I did too, was I mean, these are stocks I'm buying, and you should buy them too. And that was sort of how my business has grown. So today, I'm definitely even way heavier invested in our individual security positions than our clients are. I take way more risk than our clients, because I'm fairly risky. I'm not scared of risk. I don't know why. I just sort of like it. It's also made me wealthy, but like, we manage money much more conservatively for our clients than I do for myself, or some of the other advisors do, because we're active traders more. And so we not only eat our cooking, it's more like we're serving our cooking to everybody else, but in a manner that tastes a lot less, potentially bitter.
Well, that's a really striking response. That's, in a way, you're singing my song. That is exactly what's going on. I for my business, the Independent Speculator, it's right. Not just a matter of disclosing that I might own some of these stocks. I mean, that portfolio is what I'm doing with my money.
Exactly. And that's why I'm on TV a lot. Is they'll be like, oh, it's a Wall Street analyst, and they put on the screen, it's like he doesn't own the stock, he's never owned the stock, and basically, why do I even care what this guy says? He has like literally no skin in the game. All these analysts, and it's a waste of time. And then I'm like, oh no, I own a ton of Disney stock right now. I benefited hugely yesterday from the run up, but same with our clients, made millions. And it's because I own Disney, and I like Disney. And so, when we lose and a client, calls me up and they're like, oh, this sucks, Tesla's down 35%. I'm like, tell me about it. You know what I mean? I own it too. And so clients, I think, appreciate that because they understand we're all in this boat together and we're building great portfolios of solid long-term growth companies. And that's how I've built my wealth. And I can't really train people to do something that I didn't do. And the only reason I say you should listen to me is because it's worked for me, and I'm in a great financial position. And now I've been able to do that for thousands of other people. And, it's worked for them too. So, what we do is not new or rocket science. It's the same thing that investors who've become wealthy over the long term have always done, from Warren Buffett on forward, which is buy solid growth companies that have, great dividends and cash flow. Hopefully get them at reasonable prices, and over time you can build a lot of wealth.
All right, well, we'll have to leave it at that. Thank you very much. You've been a very interesting guest on the show.
Hey, thank you for having me. Appreciate it.